While trading in the live market, you must have noticed many times that after entering at a certain level, the price initially triggers your stop loss and later continues in the direction of your trade to reach your profit target. This happens because the price first clears the stop losses of retail traders, then reverses upward and eventually hits your profit target. This kind of market behavior is referred to as liquidity in smart money. So, if you want to avoid falling into these traps, you need to understand liquidity sweep and liquidity run. Before moving ahead in this video, if you find the content interesting, smash the like button, and if you are new here, don't forget to subscribe to our channel and turn on notifications. We'll see you right after the intro and disclaimer. In today's video, we will go step by step to understand what a liquidity run is and how it works, along with how you can identify a liquidity run on the chart. First of all, after learning the concept of what liquidity run means and how it functions, we will look at some live chart examples. Many times in the market, the price is in a bullish trend like this. By forming higher lows and moving upward, it gives buyers the opportunity to enter long trades near each swing low, which leads to a build-up of stop-loss liquidity at these levels. But after some time, without breaking its previous swing high, the price comes down, breaks its swing low, and then reverses again to continue the uptrend. At this point, the market has triggered the stop losses of retail traders placed below that swing low, forcing them out of the market. Instead of moving further in the breakout direction, the price reverses and moves opposite, clearing the liquidity that existed in the form of stop losses. This is why we call it a liquidity sweep in the smart money concept. However, after sweeping liquidity below, many times the price, instead of breaking its old swing high and going upward, continues moving downward in the opposite direction of its trend, hitting retail traders' stop losses at each level and carrying on lower. Since the price here eliminates liquidity in one direction without pausing, we call it a liquidity grab or liquidity run. But sometimes, after breaking its swing high, the market continues straight upward instead of moving down. This is also considered a liquidity run, but 8 times out of 10, the price behaves like the second example, and occasionally it rises without stopping. I hope you now clearly understand the difference between a liquidity sweep and a liquidity run. Let us now move on and check some live chart examples. This is the 5-minute time frame, where the market moves forward in a bullish trend and forms higher lows on the chart. As a result, retail traders enter long trades near every low and place their stop losses just below these levels, creating sell-side liquidity in the form of a large cluster of stop losses. Since the market keeps moving upward in the same direction throughout the day, many traders decide to hold their long positions overnight instead of booking profits, which leaves stop-loss liquidity still active. On the next day, the market opened with a slight gap up and then dropped back down toward the last swing low of the previous day. As the price reached this level, a large number of retail traders entered new buy positions, causing the price to rise on buying pressure, but it failed to break its previous high. Seeing the buying momentum weaken, some retail traders opened short trades and placed their stop losses above, which created another pool of stop-loss liquidity. If you examine this chart carefully, you will notice that liquidity from retail traders exists both above and below. But the larger cluster of liquidity is concentrated below. Because of this, the price first spikes upward to collect the liquidity above, hitting those stop losses, and then reverses downward to capture the liquidity below. Since the price continues to fall in one direction while absorbing liquidity, this is called a liquidity run, as the market runs through liquidity in the same direction. Whenever price moves this way, sweeping liquidity while continuing in a single direction, it almost always performs a liquidity sweep first before the actual liquidity run on the chart. This process forces retail traders out of their trades, making it easier for operators to control the market. While reading charts, you must always remember these key points about liquidity runs. Point number 1. Before making a trade entry in the direction of a liquidity run, you must determine on which side of the chart the majority of liquidity exists. To do this, you need to identify who holds a stronger position, buyers or sellers, by analyzing the price action on the chart. If you observe this 5-minute time frame chart of reliance on a given date, you will see that the price is consistently forming higher lows and moving upward, which indicates buyers are stronger than sellers here, allowing the price to successfully break its previous highs. Since buyers are in control, most retail traders have likely entered long trades in line with the ongoing price action, which has led to a significant buildup of stop-loss liquidity. Now, when liquidity appears on the chart at multiple levels in the same direction, the smart money concept refers to this as a liquidity pull. In simple terms, the upward movement of price creates stop-loss liquidity both below and above, meaning liquidity areas are spread apart and in opposite directions. However, when the price generates a large cluster of liquidity in one direction on the chart, it is considered a liquidity pull. In the first example, there is one fish above and one below in the form of retail traders waiting to be trapped by operators, while in the second example, many fishes gather in the same pool and in the same direction, making it easier and more profitable for operators to catch them. This is why you must identify on which side the larger liquidity is concentrated. Even after explaining liquidity pull in such a simple way, if it still isn't clear, then it becomes very difficult. Point number 2. Before entering a trade in a liquidity run, you must also check whether a liquidity sweep has occurred on the chart or not. For instance, after a bullish move on the second day, the market goes up and breaks the previous day's last swing high. As soon as liquidity is swept at this level, the price drops sharply and captures the liquidity below. This happens because operators have the ability to drive the market in whichever direction they choose. Before a real move begins, the market usually tries to force retail traders out of their positions once. That is why it is crucial to confirm the liquidity sweep. Point number 3. In a liquidity run, the price most often targets external liquidity present on the chart, because both internal liquidity and external liquidity exist on any chart. For example, liquidity located near the extreme points on both sides of the chart is called external liquidity, while the smaller price action patterns formed between these points, such as the liquidity around the highs and lows, are referred to as internal liquidity. Therefore, before going after external liquidity, the market usually creates internal liquidity on the chart, which generates activity and attracts retail traders to buy and sell heavily at those levels. In a liquidity run, the price generally aims to capture external liquidity on the chart. For this reason, after entering a trade, you can hold your profit target with a trailing stop loss until those levels are reached. Now let us see liquidity on the live chart. Here is an example run on the 5-minute time frame, where the price declined by forming a series of lower lows. This indicates that near every high, retail traders placed their stop losses above to join the market on the short side. At the same time, the stop losses of buyers who entered near the last swing low are also positioned there. But the concentration of stop losses is higher on the upper side compared to the lower side. On the next day, the market first sweeps liquidity by triggering the buyer's stop losses below with a strong bearish red candle. Seeing this bearish candle, some retail traders open short trades, expecting the market to continue lower, and place their stop losses above. This further increases stop loss liquidity on the upper side, creating a liquidity bridge. Shortly after, the price forms strong bullish candles and rapidly moves upward, grabbing that liquidity and reaching higher external liquidity levels as well. If you study this chart carefully, you will see how the market first forced retail traders out through a liquidity sweep, and later carried out a liquidity grab. If you want to enter such a trade, remember this: whenever the price initially breaks a level in the opposite direction of where most liquidity is concentrated on the chart, you should avoid entering in the direction of that breakout. Instead, wait patiently, and once the price reverses to move in line with the liquidity pull after a sweep, you can take entry with a small stop loss. That's it, traders. Thanks for watching this video. I hope you gained real value from this video. If you did, make sure to hit that like button. It truly supports the channel and shows us you're enjoying the content. And if you're new here, don't forget to subscribe for more trading strategies. Thanks for watching. Stay disciplined, stay consistent, and I'll catch you in the next episode.